Good evening, everyone. A very warm welcome to the 26th Indirect Tax Colloquium, December 2024, on decisions of the 55th GST Council meeting, threadbare and point-wise analysis, issues in customs, and FTP. I would like to introduce our speaker, Mr. Vivek Jalan, who is a qualified CA, MBA, and qualified LLM and LLB. He is the chairperson of the National Fiscal Affairs and Taxation Committee of BCCI. He is also the regular speaker of various professional forums on the key areas of direct and indirect taxes. During the session, please put your video and microphone off. If anyone has any queries,
Brata, you are not audible. Okay, I think there is some technical glitch. Samir, if you could please, do the honors and thereafter we'll start.
Sir,
Samir has written he cannot unmute himself. Please unmute Samir.
Good evening, Vivek.
Yeah, hi Samir. Yeah, we can hear
Hi.
you.
Good evening to all the participants to this Monday evening. Uh, Thank you for joining us on 26th Indirect Tax Colloquium. As you're aware, we do it every month, one colloquium at least once in a month. And mostly after the GST Council meeting or once the notifications are issued, we make sure that we do it so that we can take up all the queries, plus also, present our views, Vivek's view on the whatever the amendments proposed by the GST Council. So in this in this colloquium also we take up all the issues that was discussed in the council meeting. Somewhere, so in some cases, decisions have been taken. In some cases, decisions have been deferred or postponed, depending on the complexities. So over to you, Vivek, and please start with the session.
Thank you, Samir. And good evening to all. Thank you all for joining. And thank you to VILGST and Samir for partnering with us for over 2 years now. Thank you to Team Tax Connect also, who has worked very hard to make this colloquium a success over the last so many months and now more than 2 years. I'll share my screen, my PPT. Is my screen visible, Namrata?
Yeah, Vivek, it is
yes, sir.
available. Yes.
Visible, okay. Yeah.
Yeah, I request Vivek, the questions can be typed in the chat box, and at the end of the session you can take it up.
Yes, of course. So all the participants, I'm sure we all have many questions, and this is the benefit of attending a live webinar nowadays. So you can type your questions in the chat box and we would be happy to take up all the questions at the end of the webinar. And I will go directly on to point by point, issue by issue on all the pointers in the press release and also outside the press release. Because many of the decisions, which are discussed in the GST Council meeting, but which do not see light in the press release. So as per the informations gathered and as per the press conference also of the Honorable Finance Minister post the GST Council meeting, we will deliberate. And we have divided it into various parts on the basis of issues, and we have also divided it sector wise. This time, generally, we have this just the next day, early morning of the council meeting. This time, I have got around 1.5 days, so we could maneuver a little. So, first of all, on the GST registrations. And as I said, something first up which was not there in the press release, but which Honorable Finance Minister has announced in the press briefing. That is a new system of GST registration. So we all know that GST registrations have increased manifold over the last 7 years. Why so? Because GST is a state-wise tax, we all know. And with the increase in business, even with the MSMEs going off and selling their goods and services across India, they need state-wise registration. For example, a seller on e-commerce website, right? Can be Amazon, Flipkart, etc. Now, a seller on the e-commerce website today, if he wants to sell his products across various states, and across various states, he wants to store his goods, even though with the e-commerce operator, then as per the GST law, he is supplying his goods from that particular state and he requires a registration in that particular state where his stock of goods are stored. He may not be doing a lot of business from there. Maybe you see around 10 lakh rupees or 20 lakh rupees per month business from every state, but he would require state-wise registrations. In fact, we just got from Delhi, a call from one of these kind of dealers who were on e-commerce registered platform. They had 9 registrations and a turnover of around 17 crores. So for these MSMEs to get a registration, it is becoming a challenge under GST, specifically after the fake registration drive between the center and the states. So the registration nowadays, and all of you would agree who have opted for new registration in any state over the last 1.5 years or 2 years, that registration would take, 30 to 60 days sometimes also. The legal provisions itself require that the registration should be granted within 22 days, that is 15 plus 7 days. So 22 days are there with the officer himself to grant the registration as per law. And thereafter, there are issues, there are show cause notices which are raised, where there are concerns which are raised, and sometimes the registrations are also not granted due to small issues in the address proof, etc. And this is more so the case with MSMEs. With big organizations, of course, they are settled and they have a lot of paperwork going. But with MSMEs, it becomes more of an issue to convince the officer that, gentlemen, this is not a fake registration. It is a registration because of the GST law. So it was announced by the Honorable Finance Minister that a simplified form of registration for new businesses or such MSME businesses who are not long taxpayers. This was tabled and in principle approval was provided by the GST Council. Now the law committee would deliberate further on the process of GST registration, and in the budget you might see an amendment in the law to get going this new GST registration process. It is understood that of course there would be certain restrictions on the input tax credit which these new registrations can pass on, but nonetheless, if the registration would be quick, possibly within 2 to 3 days, subject to, of course, the input tax credit which can be passed on by these registrations. A perennial issue which is there in GST is specifically for those dealers in the goods is the vehicle detention cases. Now, when the vehicles are in the transit, then sometimes the field officers detain these vehicles due to certain issues to see the e-way bills and the documents. And uh, the field officers, they raise certain issues. Sometimes they also raise penalties, and thereafter the taxpayer of course goes for an appeal in case he wants to contest these penalties. Now, the provision under Rule 87 for this need a temporary registration is granted in such cases. Say, for example, a vehicle is moving from Tamil Nadu to Madhya Pradesh, and in between, in the state of, say, uh, Chhattisgarh, his vehicle is detained. That taxpayer does not have a permanent registration in Chhattisgarh, so the field officer grants a temporary registration under Rule 87 of the CGST rules. Now the provision under Rule 87 states that within 90 days, the registration, permanent registration has to be taken by such a person, where he actually does not require this permanent registration, right? So now a new rule is expected to be introduced, Rule 16A, which would take care of this hardship possibly, and a permanent registration would be not required for such cases or other such cases where the taxpayer does not need to get registered in the state. The taxpayer only needs to pay the taxes, and that is why he has got a temporary registration. Reverse charge mechanism. Few important changes. And first of all, from 10th of October 2024, under the reverse charge notification 13/2017 CGST rate notification, a new clause 5AB has been introduced wherein RCM would be applicable on renting of commercial property from unregistered person by a registered person. This has led to many hardships, specifically for those enterprises like, say, government enterprises also, which are exempt from GST. This new RCM provision, it is a cost to them. However, for the small composite taxpayers, this becomes a big burden. And we had raised this issue in our first colloquium after it was approved by the earlier council meeting. You can go through our video on the YouTube channel. We had raised this issue that composite taxpayers, they are also registered taxpayers, and they would also be liable for RCM for renting of commercial properties, and for them it would be a cost because they would not be getting the input tax credit. Say, for example, in a small town, a small shop owner, he is registered under composite taxpayer. He has a turnover of 40-50 lakh rupees, and he takes certainly a commercial property, a shop on rent from an unregistered individual for, say, for example, he has to pay GST 18% on RCM, and no input tax credit would be granted to him because he was registered under composite taxpayer scheme. So now, with retrospective effect from 10th of October 2024, they have relaxed this provision, and no RCM would be applicable on renting of commercial properties from unregistered person by composite taxpayers. So this is a relief to the composite taxpayers. For those who have already paid the RCM, I know what they have said, that it would be regularized on a as is where is basis. So there would not be any refund for those who have not paid or who have paid RCM already. They need not pay going forward. However, those who have not paid from 10th of October, no need to pay going forward. A big relief for non-profit organizations, say various chambers of commerce and other associations, non-profit organizations. For RCM on sponsorship. So the modus operandi was as follows. The RCM under GST was applicable on sponsorship services. Now, say for example, an association is there. We know that most associations are getting their revenues from sponsorship primarily. But say for example, an association has two types of income. One, membership income from its own members, and second, sponsorship income again from its members, right? For membership income, which also nowadays all these associations are also not very small. They have revenue of 10, 15 crores or even more in most of the cases. So for membership fees of say 1 crore rupees, they have taken a GST registration, but the major bulk, say 9 crore rupees, comes from sponsorship raised on body corporates with other members or non-members. Now, these members who are their body corporates of these associations, who are themselves corporates or LLPs, they pay the GST on RCM basis and take the input tax credit on sponsorship services. However, biggest problem was, and there were many demands across India on associations. The biggest problem in this case was that these associations had to reverse proportionate input tax credit. So in my example, 1 crore rupees revenue from membership, which is GST paid under FCM, 9 crores sponsorship, GST paid on RCM. So 9/10 of the input tax credit by such an association would have got to be reversed in such a case. And most of the associations, they missed this and they were saddled with the various interests and penalties. Through this 55th GST Council meeting decision, they have relaxed this mechanism. And where the association, in my example, say a chamber of commerce, is a body corporate itself. We know associations can work under various models. They can be Section 25 companies under Companies Act 2013. They can be cooperative societies. They can be trusts. If the association is a Section 25 company, that is, it is a body corporate, then no need to pay GST on RCM on sponsorship services. They can charge GST on forward charge mechanism on such sponsorship services rendered by them. So this is a big relaxation to such associations. But those associations who are registered at trust or cooperative societies or other than body corporates, for them, this relaxation is still not there. They have to keep charging GST, or the recipient has to keep paying GST on RCM basis, and such associations would have to keep reversing their input tax credit proportionate to the sponsorship services rendered by them. For all the multi-state registered taxpayers who are not registered under ISD mechanism, from 1st of April 2025, they have to register under ISD mechanism, right? So no more cross charge from 1st April 2025 for common services. However, question was, if such body corporate or such taxpayer in its HO has made some common payment on RCM basis, then whether through the ISD, this RCM input tax credit could be distributed to the other states. I will give you an example. Say, for example, an HO of a multi-state registered taxpayer is based out of Mumbai. It is a group company of a foreign company, right? And it pays royalty to the foreign company on the brand amount. Now, on this royalty, RCM needs to be paid by this Indian entity registered in Maharashtra, which has its HO in Maharashtra, right? Mumbai. Now, the question is this RCM on royalty, which is paid, it is a common service. It is common for all the states for which this entity is registered. Question was how to distribute this common input tax credit. The provision is already there under Rule 39, Sub-Rule 1 capital A, read with Rule 54, Sub-Rule 1 capital A. So in the Maharashtra, regular GSTIN would have to pay this RCM through its normal registration. Then from our normal registration of Maharashtra, in my example, they have to make a invoice on ISD registration, and thereafter ISD registration distributes this RCM. Now, this mechanism was not inbuilt under section 261 and the new section 20 relating to input service distributor. They have now built it into this. Another confusion was what was built in the section 20 and section 2 subsection 61 was RCM distribution by ISD on intrastate services. Interstate services distribution was not built in these two sections. Now they have proposed to build in section 5, subsection 3 and 4 of IGST Act, also under 261 and section 20 of the CGST Act relating to input service distributors, right? So now it is very clear that intrastate, interstate services which are common to all the registration of the ISD can be distributed through the ISD, and input tax credit correspondingly can be taken by the other branches in other states of the said person. Very important. Returns, assessments, and compliances. And very important decision which is taken, which would impact across India, many taxpayers. And in the last Finance Act, they have brought in section 74 capital A, so as to reduce the invocation of section 74, wherein section 73 is time barred. Well, the incentive, or you can say the propel to issue notices under section 74 and not section 73. And now after section 74A has been introduced, to the corresponding subsections on the basis of allegation of fraud, willful misstatement or suppression to the tax officer still is there after this decision. So what is the decision? In case you agree to the tax demand, or in case you have already paid the tax demand and interest also, and the officer still levies a penalty, right? And issues you a show cause notices, and for penalty only. As of now, no pre-deposit was payable on such order after the SCN, right? So in case you have, as of now, only a section 74 order for only penalty, as of now, no pre-deposit is applicable. Now, after this amendment in section 107 and 112 of the CGST Act, which will be made on 1st of February 2025 and thereafter enacted and notified, even a 10% pre-deposit is applicable on orders where there is a demand only of penalty. So 10% pre-deposit at the first appeal stage, 10% pre-deposit at the GST appellate tribunal stage, 20% pre-deposit in case the penalty demand goes to the tribunal, right? The question is, where there is a demand of tax plus interest plus penalty, would this pre-deposit be only to the tax amount 10% or tax and penalty 10 plus 10? What it comes out from the press release is the pre-deposit in cases where there is a tax, interest and penalty demand would be limited only to the 10% of the tax demand. However, where the order is only for penalty, then it would be 10% of the penalty amount. If the order is for interest and penalty, then also 10% of the penalty amount. Now, this again is a gray area where it is interest plus penalty, where it will not be applicable, this pre-deposit, because the demand is not only for penalty, but let us see the fine prints after this section 107 and 112 is amended. In our view, the provision of law, the way this press release is worded, it seems that where there is an interest plus penalty demand, then also 10% pre-deposit on only penalty may be applicable, right? So a change in appellate proceedings also. Invoice management system. We are all, whether MSME or big taxpayers, we are all impacted by the new invoice management system. They have made certain amendments which are facilitative in nature to the IMS, because as you all know, now they have made the IMS as recommendatory, not mandatory. It is optional, but IMS is here to stay, right? And they have made it very clear after this GST Council meeting by making the consequential changes for IMS in the GST law. So we all know now, after the supplier files is GSTR1, it would reflect on your IMS. In case you accept, reject the invoice, then it would accordingly go into your IMS. You can keep the invoice pending. Also, you can take no action and the invoice would be deemed to be accepted and go directly to your GSTR 2B. In case of credit note, there is no system of keeping pending. If you either have to accept or reject the credit note, right? I will come one by one, right? First, now after IMS, this GSTR 2B is not an auto-generated statement, right? So the word auto-generated, where it is used in section 39(1) and rule 61, all of those may have to be amended because it is no more so. And the provisions for IMS would need to be inculcated in those section or rule. Number 2, the modus operandi, which we know through GST network press releases, which I have just discussed. For RCM, IMS will not be applicable. For imports, what would be there for imports and movement from SEZ to DTA? So all of this would require consequential amendment to Section 38 and Rule 60. And many chambers of commerce and all the associations across, including our various chambers in which we are representing before the GST network. We recently had various programs with GST network in various associations, chambers of commerce, and all the taxpayers have requested the GST network to provide some time for the credit notes also to be pending, right? So because there is a practical problem, say on 31st of December 2024, a supplier issues a credit note. However, you as a recipient get the credit note on 21st of January 2025. And it happens. Most of the taxpayers, they are saying credit note, we get it after 20, 30 days. More so, even if it comes on the 2nd of January, the tax department or the finance department would be unaware. They are not the people who are dealing with credit note. It is the business which is dealing with the credit notes, right? And they are dealing with the supplier. It is the purchase department. And it is not possible for the finance or tax department to accept or reject the credit note. If they accept the credit note, then government will ask for reversal of input tax credit. If they reject the credit note, then it is a big business risk because the principal amount itself would be rejected. Supplier would be very happy and you would be losing money for your business. So we understand that consequential amendments to let the credit notes also be pending for a certain period of time, maybe 1 or 2 tax periods, would also be made going forward. However, we again had various sessions or, programs with the GST network. They are concerned that, see, in your example, in December, if the supplier issues a credit note, he would reverse his output tax liability in December. But you are saying I will reverse the input tax credit in February, March, right? Or afterwards. So then the government is losing interest. Who would compensate for this interest? And friends, let me tell you, the Honorable Apex Court in the case of Pratibha processors has held that interest is compensatory in nature. In case the government is losing money, then interest has to be paid, right? So it is again a question which would be answered going forward, that whether even if the credit notes are allowed to be kept pending, whether interest would be applicable or not in these cases, right? Because as per Honorable Apex Court decision in Pratibha processes, government may contest that, see, we are losing money and the taxpayer recipient has to compensate us for interest portion. So again, some water to flow under the bridge. Now again, for credit notes, if you see section 34 relates to credit notes, right? However, there is no provision under section 34 which requires reversal of input tax credit by the recipient, right? In case the supplier issues the credit note. Such a provision is available only in section 15(3)(b)(2) for credit notes related to discounts under GST. However, credit note can be issued for discounts for any other matter where the tax payable and tax charged is more than the tax payable or which should be charged, for sales returns, for deficiency in goods or services. For all of these, there is no substantive provision which requires that the recipient need to reverse its input tax credit also when the supplier reverses the output tax liability relating to a credit note. Now it seems that after amendment to section 34 and rule 67B, they would build in this mechanism and make it very clear that for all credit notes where the supplier reverses its output tax liability, the recipients need to reverse its input tax credit. So friend, all in all, IMS would require much more detailed scrutiny of credit notes when you are filing the returns. The GST return filing process would get more and more tedious after this IMS is built in. Of course, there are certain facilities which IMS has given us, but yes, credit note reconciliation would become a very critical issue for filing GST return after IMS is in force. Now, a very welcome move by the government. They have clarified that for GSTR 9C per se, individually, there would not be a separate late fee under section 47, right? So, the taxpayers who are required to file GSTR 9C, they are required to file GSTR 9 also. In case they delay in filing only 9C, or they could delay in filing both 9 and 9C, then only late fee would be applicable under section 47 only once and not twice for 9 as well as 9C. So if they delay in filing 9C both, late fee once. If they delay only in filing of 9C, then also late fee only once. And what is this late fee? Rupees 100 per day of delay or 0.25% of turnover, whichever is more. GST on vouchers. Let us understand by means of an example, right, for better clarity. Now, say for example, you go to Pantaloons and I'm just naming a particular, a particular business for understanding, because we all buy the gift vouchers from Pantaloons, etc., these malls, right? So you want to gift your friend something on their birthday. So you go to Pantaloons and buy a 10,000 rupees gift voucher, right? As the law stands today under section 12 and section 13 of the CGST Act for time of supply, GST would be payable on those vouchers at the time of purchase of those vouchers or sale corresponding at the time of purchase of the vouchers, in case the goods or services underlying in the vouchers are identifiable at the time of sale or purchase of the vouchers. So if you buy a voucher of 10,000 rupees with which you can purchase only gents garments over rupees 1,000 per garment, then GST would be applicable at the time of purchase of the voucher itself, because the goods which could be purchased from the vouchers have a single tax rate and are identifiable at that point of time. However, if the voucher is an open voucher and goods or services from the vouchers which would be purchased are not identifiable at that point of time, then the tax is applicable when you purchase the goods or services from the vouchers. However, as per the RBI, what we understand, vouchers are also methods of payments, and therefore the voucher can be called money, right? Now, question is where the vouchers, like this Pantaloon voucher, which I have just given an example, this is not money. This is not defined by RBI, right? So then would GST be applicable? Because yes, on money, GST is not applicable. So we are contended that even in case it is not money, this voucher, even then it is a claim to debt, and therefore it is an actionable claim under section 2 subsection 1 read of CGST Act, read with section 3 of the Transfer of Properties Act, and actionable claim other than those specified under entry number 6 of schedule 3, like betting, lottery, gambling, casinos, etc. They are neither supply of goods nor services under Schedule 3 of the CGST Act. Therefore, now all of these issues of GST which are raised on vouchers, so it seems from this press release, would be put to rest because the GST Council has decided that vouchers would be treated as neither supply of goods nor supply of services. Now, the question is, when would be the time of supply? What would be the valuation? When the voucher itself is not liable to GST, then what is the question of time of supply and value of supply, right? So this entire taxation under GST for vouchers, this, so it seems, is put to rest. And this would result in a big relief and dropping of various demands. But hold on. Those who are dealing in vouchers, how do they deal in vouchers? They deal in vouchers by two mechanisms, right? So, for example, this pantaloons, it has got various dealers to whom it sells the vouchers, and these dealers sell the vouchers of pantaloons to the customers, right? There can be two mechanisms. Either the dealer would be mere traders. They will buy this 10,000 rupees voucher from pantaloons at say 9,500 rupees and sell it at 10,000 rupees and make a profit of 500 rupees. In such case, it is a pure sale and purchase of voucher. And therefore, for such distribution on a principal to principal basis, no GST would be applicable. Second, in case this dealer is a mere commission agent, right? He will take the voucher from Pantaloons, sell the voucher at 10,000 rupees, pay 10,000 to Pantaloons, and get a commission of 5% on the value of the voucher sold. So in such case, the GST would be applicable on the commission of 500 rupees in my example. So now, maybe it would be more beneficial to be a trader in vouchers and not a commission agent in vouchers. Possibly business restructuring may be thought of by the voucher dealers. Now, what about the other services? These voucher dealers can render services like advertising, etc., etc., and those would be chargeable on a separate for the basis for the services rendered. Now, say for example, certain vouchers which are issued in my example by Pantaloons, these are not redeemed at all. And Pantaloons writes back the value received for these vouchers. In my example, 10,000 rupees, Pantaloons writes back as income. Would they be liable to GST as forbearance or tolerance of an act, etc., etc.? Well, as per Circular 178, it is already clarified that this income for breach of a contract would not be a tolerance of an act. It would be a receipt for non-tolerance of an act. So therefore, in our view and what it seems from the press release, this would not be applicable to GST. So this is all about vouchers. SEZ. Well, what is an SEZ or an FTWZ? Many of the dealers I am seeing here in my, in the participants, they are there who have questioned me many a times on SEZ. A very recent question which I am going to answer in this webinar also is whether in case my goods are there in SEZ or FTWZ, then do I need to add it as an additional place of business? But before this, let us understand what is an SEZ or an FTWZ, Free Trade Warehousing Zone or Special Economic Zone. Is it a warehouse? Well, in our view, it is not a warehouse. It is a special zone which is outside the territory of India. And therefore, any sale or purchase of goods when it is in the SEZ, then the entry 8AA would not be 8A would not be applicable, and the trading in the SEZ or FTWZ may be liable to GST. We all know that SEZ is a foreign territory, right? And therefore, this GST law is applicable for India. Therefore, in our view, even if this new clarification may not have come, it could have been argued that as per Section 1 of the CGST Act, GST is applicable for goods sold in India, and sale of goods within SEZ or FTWZ would not attract GST. But notwithstanding, they have, in a welcome move, brought in or proposed to bring in para 8, a new clause double A, wherein just like a bonded warehouse sale, they have decided to provide that even a sale within SEZ or FTWZ would not be liable to GST. Now, to answer my question, whether the goods in SEZ or FTWZ would require me to make LCZ or FTWZ a additional place of business or take a new registration in SEZ or FTWZ, in our view, no need, because it is a foreign territory and SEZ Act overrides all other acts as per Section 53 of the SEZ Act. Therefore, in our view, no need to declare the goods in the SEZ as additional place of business or new registration required in SEZ in case you are just storing the goods or selling within the SEZ itself or FTWZ itself. If you do not have an operations in SEZ, merely if you want to store the goods in SEZ, FTWZ, no new registration or additional place of business is required for goods lying in SEZ or FTWZ, in our opinion. Next. Well, it is applicable for all the taxpayers, and let us understand this a little in detail. In addition to what the GST Council has proposed to clarify wider circular. Say I am a manufacturer, right? I have my factory in Banaras, right? Varanasi, right? Now I do X works sale. I will take two examples. First, simple example. I do an X work sale from my factory in Banaras. A customer comes from, or dealer comes from Noida within UP, takes the delivery of the material on 31st of December 2024 from my factory in Banaras, and the vehicle reaches the dealer in Noida on 1st of January, right? The question is whether input tax credit would be available on 1st of January or 31st of December. They have clarified that the input tax credit would be available on 31st of January because the delivery, if the insurance is also taken by such a dealer, then the delivery would be, the date of delivery would be the point where the property in the goods passes on to the dealer or the customer. And therefore, the date of the supply to the dealer is 31st of December, and input tax credit would be available on 31st of December. That is the invoice date. However, friends, now second example, if the dealer who has come from, say, Gurgaon in Haryana, the question is, what would be the place of supply? In our view, under Section 10, subsection 1, clause A, the place of supply would be Banaras, that is the place at which the movement of the goods terminate to the recipient in Haryana, and therefore the manufacturer may have to charge CGST plus SGST, may not be available as an input tax credit to the dealer. This requires more in-depth analysis, maybe a further clarification from the GST Council. After this clarification, in our view, it is 10(1)(a) which would be applicable in this particular transaction and not 10(1)(b) because there is no third party as envisaged in 10(1)(b). Real estate safari retreats judgment has been negated, right? While various councils have a view that still this move of the GST Council can be challenged in the Honorable Apex Court, but what they have clarified is that the input tax credit on building or warehouses used for renting as warehouses or as malls would not be available as a plant under section 17 subsection 5 clause D. The nomenclature plant or machinery would be amended and or would be replaced by and therefore input tax credit on such building or warehouse would not be available. This is with retrospective effect from 1st of July 2017, right? So input tax credit would never be available. Again, whether this would be challenged or not in the apex court and what would be the fate of that, that is something to be seen. They have deferred the applicability of GST on FSI. FSI, floor space index is charged by the municipalities to the real estate builders, right? Question is whether RCM would be applicable on such FSI charges by the municipalities. They have referred it to going forward, maybe to the law committee. They would come back with their view because land is a state issue. GST on ACC blocks, in case the ACC block has more than 50% of fly ash content, it would be 12% under 6815 on schedule 2. And if the fly ash contents is 50% or less, it would be 18% under 6810, possibly in schedule 3. Hotels, a major relief, but not full relief. The issue was for which we have represented before the GST Council and various representations are there by the smaller hotels. In case the hotel, which has a restaurant also, for any single day in a whole year charges more than 7,500 as room tariff, even for one room, then its entire restaurant sale would be 18% and not 5%. They have proposed to amend this, and they have said that now, in case in the previous year, the hotel charges more than 7,500 for one room for one single day also, then in the next year, the restaurants would be liable to GST at 18%, of course, with input tax credit. So, if for hotels, in case even for one single day, one single room, you sell at more than 7,500 in the financial year 24-25, then from 1st April 2025, you have to charge 18% GST with input tax credit in the restaurant sale of food and beverages, right? You also have an option in the hotel industry to opt for 18% with ITC for the sale of food or beverage on the sale of your restaurants, right? So that is an option. You can start the year with charging 18% with ITC or 5% without ITC. A relief, but what about the previous demands? It is not with retrospective effect. So previous demands stay. Possibly some more work for the hotel industry with the GST Council, right? And they have to pitch in to regularize all previous demand on an as is, where is basis, because the case from what it seems is already accepted by the GST Council. Auto industry, well, in case the motor vehicle fund as per Motor Vehicle Act pays takes the insurance from the insurance company, no GST is applicable because already on these premiums, insurance company has charged the GST. On electric vehicles, old electric vehicles sale, 18% would be applicable on the margin. So we all know that wide notification dated 8 2018, dated 25th of January 2018 on the margin, that is the cost price, sale price minus cost price for motor vehicles, 18% GST is applicable on all other motor vehicles and 12% for electric vehicles. Now they have made it consistent. Even electric vehicle, old electric vehicle resale would be 18% on margin, that is the profit. Just a moment. Right. So there is a, that is a insertion of an explanation for SUVs in notification 1 2017 for compensation cess, right? So compensation cess at the rate of 22% would be applicable from 26th of July 2023, as has been clarified. The field officers were of the view that explanation is only a clarification and it is with retrospective effect. So now they have clarified, no, this explanation also is with prospective effect. Only for auto industry, but this analogy can be used by other industries also. Many of the times it is contested by the taxpayers that this explanation is also very specific and it is applicable prospectively from the date when explanation has come into effect, right? Agri-business, popcorns, well, you have to go to the social media and already there are so many memes on popcorns. Already before the council meet also there were so many memes on popcorns. So all of the study material on popcorns is available on social media. But just to simplify, clarify in simple terms, ready to eat popcorns with mixed salt and spices, not pre-packed or labeled 5%. Pre-packaged and labeled 12%. So if they are packaged, they become namkeens, right? So again, this is something which has been explained. However, the most critical is if caramel or sweetener is added to the popcorn, it becomes a confectionery and 18% is applicable. Well, if this is the intention of the council, then I would dare say that many of the other products, when we are in litigation for many other products, where a particular milk product by adding of sugar is alleged by the GST department that it has become a confectionery, right? So a milk product becomes a confectionery merely by adding added sugar. That analogy can be drawn from this popcorn issue, and therefore all the ready-made eatable items, they have to re-understand and revalidate the GST rate in their businesses. GST on races, first of all, they have very clearly specified that agriculturalist, even if he packages the goods in a package, pre-packed and labeled, the goods, then agriculturalist need not take a registration, no tax on agriculturalist, right? And they have linked all the tax with legal metrological act. So in case the legal metrological act, they are selling it in the retail space, then only tax would be applicable. A relief, no GST on banking charge, penal charges of interest or penalty for banking. So banks cannot charge you GST on the penal interest or penalties, right? Payment aggregators would be exempt, payment gateways would not be exempt, right? So that is what they have clarified. E-commerce operators who are merely supplying the goods, like restaurants, they are merely supplying the goods, and under 9 subsection 5, the e-commerce operators have to pay GST on these restaurant services and therefore they would not be required to reverse ITC on the payment of restaurant services from the e-commerce operators GSTIN. That has been clarified. E-commerce operators, online OIDAR services, online money gaming, right? They have to specify the state name and state code so that the place of supply is the particular state and the tax goes to the state, right? So if you have an online registration based business, then you just cannot put a place of supply as your own state. That is under section 12(1)(b), 2B2, right? You have to mention the state name and the state code of the recipient and therefore charge GST accordingly. Track and trade mechanism, right, for evasion products, already for gutka, pan parag and all, a new system is there for GST. Now they are saying that they will build in a new track and trace mechanism where each unit or container or package of that pan parag, gutka or such evasion prone products, they would be tracked with a identification mark or a barcode or something like that throughout the supply chain. So pan parag package goes out of the factory with barcode tracked to the dealer, wholesaler tracked by the barcode and goes to the retail tracked again. So this mechanism would be there throughout the supply chain. It would make certainly these evasion prone products like pan parag, gutka, etc. more difficult. Various rate changes for goods have happened in GS this time in the council meet, and most important is that for compensation cess related goods, if you are exporting it and if you are selling it to the exporter as merchant exporter, earlier they were of the view that for merchant exporter only GST would be 0.1% and compensation cess would be total. So if you are merchant exporting to an exporter the cans of canned beverages, then compensation cess would be 12% and GST would be 0.1%. Now they have clarified that compensation cess would also be 0.1%. So this is a beneficial clarification which they would be issuing. So I think we have covered all the points in the GST which has been taken up by the GST Council meeting, and we would quickly go on to the questions. Yeah. So first question, Sunidhi. Okay. What about RCM on recovery agent services? Any clarifications expected? As of now, there is no clarification as far as, we have not represented on the recovery agent services, RCM, as of now. So, as of now, nothing expected. Okay, can we distribute RCM per sales ratio whenever it is not specified? You see, sales may not be the right term. The term which they have specified is turnover in a state. So you need to say turnover as per GST. They have defined what is turnover in a state. You have to see that ratio and you need to segregate or divide distribute the RCM, even in case you are cross charging. Mr. Sunil says we need to abide under rules 37, reversal of ITC for purchase from subsidiary when it comes to unrelated party definition. For example, we procure raw material from subsidiary, sell goods to them in normal course of business. The payments are settled only through book adjustment. If invoice is payment falls under 180 days, then we are required to reverse input tax credit through no, they have already clarified. Mr. Sunil, if you can go through this, you see, rule, I think 37 itself, right? It is already there. For payment from subsidiary, this 180 days would not prevail, and the payment date would be considered to be the date of the book entry, right? So it is already covered. 180 days not applicable for subsidiaries or such related parties. Now, the question is they have done it for foreign associates, right? And even book adjustments, right? Even book adjustment otherwise also would be considered as a payment mechanism. So it is already covered by various case judgment, and book adjustment would be considered as payments. Therefore, this 180 days rule 37 proviso would not be applicable in such cases. Book adjustment would be considered to be as payments. Current provision states that orders involving penalty under 129(3), 25% shall be deposited to file the appeal. The council has recommended 10%. Does it mean for 129(3) orders? Yes, Mr. Sanmitra, for 129(3) orders also 25% has been reduced to 10%. But generally under 129(3), you pay off the entire penalty and thereafter release your goods and then go for appeal. But yes, if you are not paying that 200% penalty, then 25% has been reduced to 10% while this recommendation. Related to blocked credit, but there are two queries. First, related to blocked credit, booked but not in GSTR 2B. How should the impact of blocked credit reflected in books but not in 2B be handled under 3B? Well, if blocked credit is not there in the GSTR 2B, right? Therefore, as per 16(2)(BA, you cannot take the input tax credit and then reverse it, right? So you cannot take cognizance of that in GSTR 3B. Should this figure be disclosed as per books? No, I have answered. If it is disclosed, it will cause a mismatch subsequently when block credit, what will be the impact on IMS and 3B. So if whenever block credit appears in the IMS, only then you can take it in 2B and reverse it in 3B. Till it does not come in IMS, no question of taking it in 2B or 3B directly. Okay, second question by Mr. Sunil, credit note in 2B but not in books. When a credit note is in 2B but not being booked, we reverse it in IMS and recompute the ITC. But those credit note is generally related to us. After discussion from supplier, it will be booked in a subsequent month. What is the ideal method for handling this scenario? Mr. Sunil, you cannot reinstate a credit note which you have reversed in the IMS or rejected in the IMS. Your supplier will have to pay the corresponding GST on the credit notes which you have rejected in the IMS in the first month. With interest, right? Supplier will have to pay with interest, irrespective of the fact whether he issues you a new credit note in the next month. How can the supplier identify which credit note has been rejected and reversed by the recipient? Well, what we understand from GST network, they are bringing in a facility to give the remarks in the IMS. So I think this problem will be resolved going forward. Mr. Sambamurthy says, due to insertion of FT, WZ, SEZ as 8AA, will there be any impact on the input tax credit reversal? No, there would not be any impact because there is no supply at all. So I don't think there is any impact because you pay the IGST only when the goods are released from the SEZ or FTWZ, right? Now the question is whether this no supply would be liable for reversal under Rule 42, 43. In our view, not at all. No supply would not be required for the purpose to be taken in the exempt turnover as per Rule 42. However, we need to see the corresponding amendment to section 17(3), right? But in our view, this would also see uh, the amendment to 17(3), just like it was done in case of 8A. From Krishna Mohan, is endorsement mandatory for SEZ supply or is it required only at the time of claiming ITC refund? It is mandatory. SEZ endorsement is mandatory. Is ITC allowed on construction of prefabricated material which is removal for warehouse? Where your question is not clear, but if you are saying this prefabricated material is not immovable property, it can be removed without being substantially destroyed, then in such a case, whether it becomes a movable property. In our view, in the case of Sirpur paper mills, it has been decided by the Honorable Supreme Court. In case you can demonstrate that this property is capable of being removed without being substantially destroyed, then it would be a movable property. ITC should be available. Mr. Shashank says, please guide on treatment of invoice and credit note, both not accounted by the recipient in book. Invoice is before IMS implementation, credit note after IMS implementation. Yes, so this is a practical issue where invoice is booked earlier, credit note has come afterwards. So invoice, you have already taken the input tax credit. Now credit note has come as IMS. Now you take it in 2B and reverse the input tax credit correspondingly, right? If it is eligible, I mean, if this credit note relates to you. Is it mandatory to obtain declaration for credit note issued for sales return in service not done? As of now, a declaration is better to be taken even after IMS, right? Because IMS is not mandatory. Once IMS becomes mandatory, this becomes a good question. Then it has to be seen whether the council decides otherwise for the declaration part under Circular 212. Do we need to make mandatory pre-deposit for penalty orders under section 73, 74 also if we file the appeal for this penalty order and tax and interest has already been paid? Yes. Mr. Ashok Jha, for penalty orders only 10, 10, 20, 10% pre-deposit plus 10% for GSTAT will now be applicable after notification of the amendment to section 107 and 112 as proposed by the council. Credit note either rejected or kept pending, will it be considered as accepted? Rejected will not be considered as accepted. Credit note cannot be kept pending as of now. Maybe going forward, they would bring in a utility to keep it pending. As of now, if you take no action, then it will be deemed to be accepted. And as I said, the department would come to you for reversal of input tax credit with interest. Okay, last question. If customer has inadvertently rejected credit note on IMS, how can it be corrected? Is it a hit for the supplier? Yes, it is a hit even if the supplier issues a new credit note in the next month. And it is a hit with interest, right? Until unless, of course, it can be demonstrated otherwise. So yeah, this PPT will be shared with you. Thank you very much again to all the participants for joining. Thank you very much. Over to you, Samir and Namrata.
Thank you, Vivek. Thank you for taking us through all the amendments and all the changes that is given in the press release and otherwise. Uh, you can always put in the question in the mail if you have any other query which has not been answered, or you can always put a mail to me or to Vivek, and we'll take it up individually. Thank you again for joining us, and we'll see you in the next session once we have the notification out by the department. So over to you, Namrata, for the closure.
Thank you, Vivek sir, for this wonderful deliberation. And thank you, Samisa, for coordinating with us. Thank you to all the participants for attending the webinar. We conduct such webinars every month and hope to see you all in the upcoming webinars as well. We will shortly share the PPT and the video link to all the participants. Thank you all once again.